Welcome back, guys. This is another HL-only lesson, and today we'll be continuing learning about different types of market failure, which occurs when the market fails to do what's best for society. But as we'll learn today, sometimes the failure isn't due to the behaviors of the market, but the way the market itself is set up. What I'm talking about is called market structure, and this refers to a set of characteristics about the way a market is organized that will allow rational producers to act in certain ways. Some market structures allow firms to have greater control over the price at which they sell their product. This is called market power. If a firm has no market power, it has to accept the market price as given. If it has a lot of market power, it can raise prices above costs without losing all its customers. The amount of market power a firm has depends on factors like the number of competitors, how unique the product is, and how easy it is for new firms to enter the market. There are 4 different market structures that you'll need to know for DP Economics. I'll be making a separate video lesson for each that will go into much more detail on the individual characteristics, but in today's lesson, I'll just be giving a brief introduction and highlighting the key differences between them.
But before we get into the different market structures, let's first talk about the set of characteristics that are used to define them. The first one is simply the number of firms within the industry. As you can imagine, the fewer firms there are in a market, the more market power each individual firm would have. That's easy to understand. And the number of firms in an industry is heavily dependent on the next characteristic, which is barriers to entry. This refers to anything that will prevent a firm from entering an industry and beginning production. In other words, barriers to entry tells us how easy or difficult it is to enter a market. When there are no barriers to entry, we say there is free entry. Obviously, if there is free entry, there are more likely to be a higher number of firms in the industry, which means less market power for each. The next characteristic is product differentiation. Even though firms may sell the same product, they may try to gain an advantage over the competition by making their products slightly better and therefore different than the other firms. For example, Nike and Adidas both sell basketball shoes, but if you believe that Nike shoes are better than Adidas because they are somehow different, you may be willing to pay a higher price, and therefore Nike has greater market power. However, as we will learn later, it is not always possible to differentiate your product, resulting in less market power. Okay, so now that we know the characteristics, we can then use them to classify the 4 market structures. Let's start with the only market structure that doesn't cause market failure: perfect competition. This is the only market structure where allocative efficiency is achieved. Let's find out why that is. In perfect competition, there are a very large number of firms, and each firm is extremely small compared to the overall market. The products sold are identical or homogeneous, so consumers see no difference between one firm's output and another's. Because there are so many sellers selling identical products, no single firm can influence the market price. Firms in perfect competition are price takers, meaning they must accept the price determined by market demand and supply. There's also perfect information, so buyers and sellers know all prices and quality levels, and there are no barriers to entry or exit. If firms are making profit, new firms can easily enter the market, and if firms are making losses, they can leave without difficulty. As a result, firms in perfect competition have zero market power. As you can imagine, having all of these circumstances occur in the real world is highly unlikely, so a pure perfect competition market structure is mostly theoretical. But there are some that come close. Think about the last time you bought fruit or vegetables. Do you remember the name of the producer? Probably not. But why? It's because you don't really care which producer you buy from, because a potato is pretty much going to taste the same regardless of who produced it. In other words, the product is identical and not differentiated, so you don't even pay attention to who you are buying it from. That's perfect competition. And the only way you might know the producer is if you bought from one of the big 3, Dole, Del Monte, or Chiquita. You are more likely to remember these producers because they have much more market power because they make up what's called an oligopoly. but we'll learn about that later in the video. Let's get back to perfect competition. Probably the best example of a perfectly competitive market is currency exchange. With the potato example, there are different types of potatoes, or you might prefer potatoes grown in different parts of the world, so there is some product differentiation there. But with currency exchange, the money you get at one exchange is exactly the same as the money you would get anywhere else. There's absolutely no product differentiation there. However, there still would be some barriers to entry. Since you need permits to operate legally, there are some barriers to entry. So, again, since this does not meet the requirements of a pure perfect competition market. So, you might be asking, if perfect competition doesn't exist in the real world, then why take the time to study it? As I said earlier, it's the only market structure where allocative efficiency is achieved. This means that the market is producing exactly the correct products and quantity that is best for society, and exactly the right amount of resources are going towards that production. Nothing is being wasted. Obviously, that's not realistic, but it is the goal. So then perfect competition is the market structure that we need to use as a standard to compare the other market structures to in order to evaluate their effectiveness.
So with that in mind, let's go to the complete opposite extreme and look at monopolies, which represent the highest possible level of market power. A monopoly exists when there is a single firm producing a good or service with no close substitutes. Because consumers have no alternative suppliers, the monopolist is a price maker rather than a price taker. Monopolies usually exist because of strong barriers to entry. These barriers might include legal protection, such as patents or government licenses, control over a key resource, very high startup costs, or economies of scale that make it inefficient for multiple firms to operate. Because of these barriers, potential competitors cannot enter the market easily, allowing the monopolist to maintain significant market power over time. This power allows the firm to be a price maker, allowing them to set their prices much higher than would otherwise be possible. And if perfect competition results in no market failure, you might have already guessed that its opposite, monopolies, results in the highest level of market failure. As such, most governments have laws to prevent monopolies. So once again, it is difficult to come up with examples of pure monopolies, although there are definitely companies that have come close. There have been many historic cases where a single dominant firm has gained too much market power and has been ordered by the government to change its business operations in order to make the industry more competitive. Probably the closest example to a monopoly that commonly occurs is a city's public utilities. This will be things like electricity, water, telecommunications, among others. The initial startup costs required to establish the infrastructure to run these kind of businesses are huge. And once one firm already has the infrastructure in place, it would be very risky for another firm to establish their own infrastructure and try to compete. This enormous barrier to entry usually means there's only one single provider for a given geographical area. But to prevent the market failure caused by monopoly, this company is usually state-owned, or at least has some agreement with the government to offer the product at affordable rates. So again, this wouldn't be an example of a pure monopoly, but could very easily turn into one without government intervention. So those are the two opposite extremes of market structures, but most real-world markets fall between perfect competition and monopoly, and what we call imperfect competition. Imperfect competition includes market structures where firms have some market power but not complete control over the market. One important type of imperfect competition is monopolistic competition. In monopolistic competition, there are many firms similar to perfect competition, but the key difference is product differentiation. Firms sell products that are similar but not identical. This differentiation might be based on branding, quality, design, location, or customer service. There are still relatively low barriers to entry, so if firms earn profit in the short run, new firms will enter the market, reducing profits in the long run. Because products are differentiated, firms have some ability to raise prices without losing all customers, which gives them a small degree of market power. Monopolistic competition is the market structure that you, as a consumer, experience the most.
Every time you go shopping in the supermarket, you walk down the aisle filled with very similar products from many different producers with many different prices. All of them are trying to convince you that their product is somehow better than the rest in order to justify their price. Many students get confused because they see the word monopolistic and relate it to a monopoly. Be careful not to make that mistake because it's very different. Monopolistic competition is like if perfect competition and a monopoly had a baby. It's a mix of the two. There are many firms competing for market power, but if one of them can differentiate their product enough to convince consumers to buy their products and not other, that firm may one day gain enough market power to be classified as a monopoly, whereas firms in a perfectly competitive market could never do that because they are all selling identical products. So examples of monopolistic competition would be pretty much any company you see selling things in a mall. But a more specific example would be the tea shops in Taiwan. They're everywhere. They all sell pretty much the same thing, but they're also constantly trying to innovate to come up with new flavors or new marketing schemes to help differentiate their product from all the other tea shops. Some are more popular than others and so therefore have more market power. This power then gives the firm more control to raise their prices slightly more than their competition. Although unlikely, it is possible that the firm then continues to gain more and more market power, forcing other tea shops out of business and eventually becoming the dominant tea shop in all of Taiwan.
But when it comes to things like tea shops, everyone is going to have their preference on which brand they prefer. So instead of a single dominant firm taking over the whole industry, what's more likely to happen is that several dominant firms share complete control over the industry. And this brings us to our next market structure, oligopoly. An oligopoly exists when a small number of large firms dominate the market. Because there are only a few firms, each firm's actions affect the others, leading to a high level of interdependence. Firms in oligopoly may compete on price, but often they compete using non-price strategies like advertising, branding, loyalty programs, or product innovation. Depending on the industry, differentiation could occur, but some oligopolies sell identical products. Barriers to entry are usually high, which helps existing firms maintain market power. Oligopolies can result in outcomes ranging from intense competition to collusion, depending on how firms interact. Therefore, the control over the price for each firm depends on the level of cooperation of the oligopoly. We will examine this in much more detail in a later lesson. But even if they compete with each other, each firm still holds a significant amount of market power and control over the price, since there are so few firms and barriers to entry are high. Take a look at your phone. I'd be willing to bet a lot of money that you either have an Android or an Apple operating system. I'm extremely confident I'll win this bet since those two control 99% of the smartphone operating system market. This two-firm oligopoly is called a duopoly, and it's an example where the firms are competing against one another and trying to offer better products for lower prices. An example of an oligopoly where the firms are colluding or cooperating with one another is OPEC, or the Organization of Petroleum Exporting Countries. This oligopoly is made up of countries that produce oil and will regularly meet and decide on production and price levels to sell at. As we will examine later, this collusion is more beneficial for each individual firm, but does come with its risks.
And that's going to be just about all for this introduction to market structures. Understanding market power is essential because it affects prices, output, efficiency, and consumer welfare. Markets with more market power tend to charge higher prices and produce less output than competitive markets. This is why governments often regulate monopolies and oligopolies, while competitive markets are usually left alone. As we move forward in this unit, we'll analyze these market structures in more detail, look at diagrams showing costs and revenues, and evaluate how different levels of market power affect efficiency and economic welfare. For now, the key takeaway is simple. Market structures determine how much power firms have, and market power determines how firms behave in the real world. Make sure you can explain all of the learning objectives here, and as always, leave any questions in the comments. Thanks for watching, and I'll see you in the next video.